Great to see you continuing on your financial journey with the Hypatia Investathon. If you are following the course, you now have opened an account and are ready to go. Or maybe you already have an account and are wondering what to do with it. Well, we suggest following one of the most famous and best investors in the world, Warren Buffett. What does legendary investor Warren Buffett recommend for his own wife? Well, it is something called the 90-10 strategy. The 90-10 strategy is to invest 90% of your investments into stock-based index funds while keeping the remaining 10% in cash or cash equivalent investments. This strategy is designed to generate higher yields, which means make more money for you in the overall portfolio over the long term. Of course, the 90-10 rule is merely a suggested strategy. This can be easily modified to reflect a given investor's awareness and appetite. Investors with lower risk appetite levels can adjust lower equity portions to the equation. For example, an investor who wants less risk in their portfolio can invest with a 70-30 split, or even a 60-40 split. Remember that the cash equivalent, or fixed income, also known as debt instruments, will probably make less money over the long term than equity securities. You are trading risk for reward. Warren Buffett not only recommends for the 90-10 plan in theory, he actively puts this principle into practice. In Berkshire Hathaway's 2013 letter to shareholders, Buffett discloses he uses the principle as a trust and estate planning directive for his wife, as laid out in his will. Of course, each individual has unique circumstances. There are variations of Buffett's 90-10 investing strategy that take into consideration the investor's age and risk awareness and appetite. As an investor nears retirement, it's frequently a good idea to rebalance a portfolio to reflect a more conservative approach toward investing. Investors need to protect their nest egg so they have funds to live on during retirement. Because a retiree may need the funds to live on, continuous growth may not be the correct investment strategy. In fact, at retirement, the investment strategy might change considerably, switching the allocation so that 90% of funds are put in low-risk government bonds and 10% are invested in broadly diversified funds. Other examples could be investors who are bearish, which means they think the market will go down. These investors might opt for the 10/90 allocation amounts as part of a crash protection strategy. But for the investor who is still far from retirement, we think Warren Buffett's investment strategy for his wife, the 90-10 strategy, is a great place to start your investing journey. See you at the next Hypatia Investathon video. This recording has been provided for informational purposes only and should not be considered as investment or tax advice or as a specific recommendation.